Welcome to Chapter 12, Retirement Saving through 401k Plans. This chapter treats the workplace retirement plan as much more than a menu of mutual funds. It is an operating system that connects payroll, employer contributions, tax rules, record keeping, investment selection, defaults, participant communication, and fiduciary oversight. Small design choices can compound for decades. A 3% default can become an anchor. A match formula can encourage saving or confuse it. A target date fund can create a diversified portfolio, but the date on the label does not know the participant's pension, spouse, outside assets, or tolerance for loss. We will trace a payroll dollar into the plan. Compare traditional and Roth contributions. Evaluate menu design and qualified default investment alternatives. Examine leakage from loans and cash outs, and apply a prudent process to fees and service providers. The central idea is simple. Retirement outcomes are produced jointly by markets and behavior. The plan sponsor cannot control returns, but it can build an environment in which participants need fewer heroic decisions to reach a reasonable result. The 401k system asks ordinary workers to solve a difficult problem. Save consistently, choose an asset allocation, understand taxes, resist market timing, and avoid spending the money for several decades. Most people do not arrive at work hoping to compare glide paths over lunch. Yeah, that is why plan design matters. Automatic enrollment can bring employees into the plan. Automatic escalation can raise saving gradually. The employer match can reward participation. A qualified default investment alternative can provide a diversified portfolio when the employee makes no investment election. At the end of the first quarter of 2026, 401k plans held an estimated $9.9 trillion, with about 58% in mutual funds. The regular employee deferral limit was $24,500, and eligible participants ages 60 through 63 had a special catch-up limit of $11,250. Those numbers show scale, but the behavioral point is more important. A default is not neutral merely because employees can opt out. It can feel like advice. Good design uses that influence deliberately and explains it honestly. This chapter develops 4 practical skills. First, trace the money. You should be able to follow payroll deferrals and employer contributions through the trust, record keeper, investment allocation, and participant account. Second, design the plan. That means evaluating eligibility, automatic enrollment, escalation, the match, vesting, loans, hardship withdrawals, and distribution rules as a connected system. Third, compare the investment and tax choices. You should understand traditional versus Roth contributions and evaluate core menus, target date funds, balanced funds, managed accounts, and brokerage windows. Fourth, govern the process. A plan committee must select and monitor providers, investments, fees, communication, cybersecurity, and operational controls using relevant evidence. Notice that only part of this chapter is about picking funds. The larger task is determining whether the plan makes saving, diversification, and continued participation reasonably easy without pretending that any default is perfect. By the end, you should be able to explain not only what the plan offers, but how the design is expected to influence behavior and how the committee will know whether it is working. 4 connected questions organize the chapter. First, how does money enter the plan? We will examine eligibility, payroll deferrals, the employer match, profit sharing, limits, and vesting. Second, how is the money invested? That includes the core menu, the qualified default investment alternative, target date glide paths, fees, rebalancing, and participant choice. Third, where is retirement wealth placed at risk outside normal market movement? Loans, hardship withdrawals, small balance cash outs, poor diversification, and panic selling can interrupt compounding. Fourth, how does the fiduciary process hold the system together? The committee must define objectives, evaluate providers and investments, benchmark costs, document decisions, communicate clearly, monitor results, and act when evidence changes. These questions are linked. A generous match has limited value if the employee never enrolls. A strong menu has limited value if participants sit entirely in cash. A low fee has limited value if the record keeper repeatedly loses payroll files. Retirement outcomes emerge from the interaction of rules, markets, operations, and behavior. It is a chain, and the weakest link tends to send the invoice. The participant owns the account, but 6 decision makers shape the environment around that account. The plan sponsor establishes the plan, appoints fiduciaries, selects providers, and funds employer contributions. The plan committee runs the prudent process for investments, fees, operations, and monitoring. The record keeper maintains individual accounts, processes payroll files, posts transactions, and provides participant tools. The trustee or custodian holds plan assets and supports settlement. Investment providers supply mutual funds, collective trusts, stable value products, annuities, or managed solutions. Finally, the participant elects contributions and investments, may take a loan or withdrawal, and ultimately experiences the market outcome. This is a delegated system, but delegation does not erase responsibility. A sponsor can hire excellent vendors and still have a weak plan if nobody owns the handoffs or reviews the evidence. Participant direction also does not eliminate the sponsor's duty to design and monitor the environment prudently. Think of the plan as an apartment building. Participants choose how to furnish their units, but the sponsor still has to maintain the wiring, elevators, fire alarms, and front door. A payroll contribution looks small, but it depends on a precise 6-stage process. First, elect. The participant chooses or defaults into a contribution rate and traditional or Roth tax treatment. Second, withhold. Payroll deducts the employee contribution and calculates the employer contribution under the plan formula. Third, transmit. Cash and participant level allocation data move promptly to the trust and record keeper. Fourth, invest. The record keeper directs purchases according to the participant election or qualified default investment alternative. Fifth, record. Units, sources, vesting, balances, and relevant tax information are posted to the participant account. Sixth, monitor. The sponsor and providers review contribution limits, late or failed files, unmatched cash, investment results, fees, and participant activity. Every stage creates a control question. Was the election current? Did payroll use the right compensation? Did cash and data agree? Was the correct fund purchased? Did the account receive the right number of units? Repeated small errors can become large harms when multiplied across 26 payrolls, 1,500 employees, and several years. Retirement administration is compound interest applied to operations. Unfortunately, mistakes compound too. Plan design gives the sponsor several powerful levers. Automatic enrollment places eligible workers into the plan unless they opt out. Automatic escalation raises the contribution rate over time, often by 1 percentage point each year, subject to a cap and participant choice. The employer match links company dollars to employee saving and can create a visible incentive to contribute. Immediate eligibility reduces the risk that mobile or younger workers lose important early years of compounding. Re-enrollment can move participants with no affirmative election or participants stuck in extreme allocations into a designated default unless they opt out. Vesting and portability determine when employer dollars become the participant's property and how easily balances move after employment ends. Each feature can improve outcomes, but no default is automatically wise. A 3% enrollment rate may raise participation while anchoring employees at a contribution that is too low. A match ending at 6% can also be interpreted as the amount one is supposed to save, even when it is only the point at which the employer stops matching. The plan should therefore choose defaults as recommendations with opt-out rights, not as random settings left behind by the last vendor conversion. Traditional and Roth 401k contributions can use the same investment menu. The difference is when income tax is paid. A traditional contribution generally reduces current taxable income, subject to plan and tax rules. Investment earnings then compound tax deferred, and distributions are generally taxed as ordinary income. The structure may be attractive when the participant expects the current marginal tax rate to exceed the future retirement rate. A Roth contribution is made with after-tax dollars. There is no current deduction, but qualified withdrawals are generally tax-free. That can be attractive when the future rate may be higher or when the household values tax diversification. The hard part is that future income, tax law, spending, and required distributions are uncertain. This is not a contest to predict Congress 30 years in advance with perfect confidence. Many participants can split contributions, creating both traditional and Roth balances. That turns an all-or-nothing forecast into diversification across tax timing. The right choice depends on current rate, expected career path, cash flow, other assets, retirement income, and the value of flexibility. Same portfolio, different agreement with the tax system. Students often jump immediately to the question, which fund earned the highest return? This equation shows why that is incomplete. Ending wealth reflects employee contributions, employer contributions, investment growth, fees, and leakage. The contribution rate, escalation schedule, tenure, and missed payrolls determine how much capital enters the account. The match formula determines how much employer support the participant captures. Asset allocation, diversification, rebalancing, and time in the market shape investment growth. Fees, loans, hardship withdrawals, cash outs, taxes, and penalties remove capital or slow compounding. Consider the example on the slide. An employee saving 6% with a 3% employer match receives 50% more annual contributions than an employee saving 6% with no match. Before either portfolio earns a dime. A few basis points of fund outperformance cannot rescue years of undersaving or a repeatedly interrupted account. Markets matter, but behavior supplies the capital that markets compound. The lesson is not to ignore investment quality. It is to rank the drivers correctly. Contribution adequacy and leakage prevention are often the large rocks. Fund selection is important, but it should not become a very sophisticated discussion about deck chairs. A strong core menu covers essential exposures without turning the plan into a fund supermarket. A capital preservation option can serve participants with low risk or near-term needs, although stable value, money market, and short duration funds have different structures and risks. U.S. equity exposure should usually include a broad core with carefully chosen complements only when they add a clear role. International equity adds geographic and currency diversification. Fixed income should provide a diversified core with transparent duration and credit risk. Asset allocation options, such as target date or balanced funds and managed accounts, let participants obtain a complete portfolio without building it security by security. A brokerage window expands choice for sophisticated users, but it also expands opportunities for concentration, speculation, and confusion. More choices can create the appearance of sophistication while reducing decision quality. Behavioral research has repeatedly shown that too much complexity can discourage action or lead people to naive allocation rules. The committee should ask whether each option has a distinct job, whether participants can understand the differences, and whether the plan can monitor the menu effectively. A menu is a decision architecture, not a trophy case for every fund family that bought lunch. Target date funds automate 3 difficult decisions: asset allocation, changes in risk over time, and rebalancing. A participant chooses a fund associated with an expected retirement year And the fund combines equity, fixed income, cash, and sometimes other diversifiers. The glide path changes that allocation as the target date approaches. Some funds follow a to-retirement design and reach their most conservative point near retirement. Others follow a through-retirement design and continue changing for years afterward. Underlying portfolios may be active, indexed, or blended, with meaningful differences in fees, tactical tilts, manager risk, and equity exposure. The financial crisis made the industry pay closer attention to how widely near-date target funds could differ when markets fell. The date in the name was never a promise that funds with the same year would behave the same way. A single date also cannot see the participant's pension, social security plan, spouse's assets, risk tolerance, or withdrawal pattern. Target date funds can be excellent defaults because they provide diversification and discipline. They are still portfolios, not autopilot certificates or guarantees of income. The date is a useful coordinate, not a complete financial plan. At the end of the first quarter of 2026, U.S. 401k plans held an estimated $9.9 trillion. Mutual funds accounted for about $5.7 trillion, or 58%. Within the mutual fund portion, equity funds held about $3.3 trillion, hybrid funds about $1.6 trillion, and bond plus money market funds about $800 billion. The first observation is scale. Workplace plans are one of the fund industry's most important distribution and ownership channels. The second is that mutual funds are large, but they are not the entire system. Plans also use collective investment trusts, stable value products, separate accounts, company stock, annuities, and other vehicles. Collective trusts, in particular, can offer institutional pricing and flexible structures, but they use a different legal and disclosure framework from registered mutual funds. The chart, therefore, should not be read as a recommendation for one wrapper. It is a market map. The plan committee still needs to compare exposure, cost, transparency, operations, portability, participant communication, and the quality of the service ecosystem around each option. The 401k did not arrive as a complete national retirement blueprint. It evolved. ERISA, in 1974, established major federal standards for fiduciary conduct, reporting, and participant protections. The 1978 tax code provision that became Section 401k created the foundation for salary deferrals. During the 1980s, employers rapidly expanded participant-directed defined contribution plans, and responsibility shifted increasingly from the employer's pension promise to the employee's account. The Pension Protection Act of 2006 gave major support to automatic enrollment and qualified default investment alternatives. Secure 2.0 in 2022 continued the movement toward automatic features, catch-up rules, and broader retirement provisions. In 2026, the elective deferral limit rose to $24,500, while the special age 60 through 63 catch-up remained $11,250. The direction of reform is revealing. Early policy focused on creating access and legal structure. Later policy focused more heavily on participation, adequacy, portability, defaults, and retirement income. The account became powerful, but it also transferred more decisions to individuals. The system has spent decades trying to give those individuals better guardrails without removing their choice. This case shows why a diversified default is not self-executing. The plan finds that many employees hold concentrated company stock or remain entirely in cash. The committee considers re-enrolling participants who have not made an affirmative election into age-appropriate target date funds. That could reduce two extreme risks: concentration in one employer and long-term underinvestment in cash. But the committee cannot simply choose the largest target date series and press a button. It must compare the glide path, underlying investments, fees, manager, risk, and fit with workforce demographics. The notice must explain that the fund can lose money, that the employer is not guaranteeing the outcome, and that participants can opt out. Operations must validate birth dates, mapping rules, blackout periods, account restrictions, and transaction controls. Monitoring must review allocation, fees, series changes, complaints, and participant behavior. The communication challenge is real. Some employees may interpret the default as personalized advice or a guaranteed retirement solution. A date in the fund's name is a planning coordinate, not a reservation confirmation. Re-enrollment can improve diversification, but it deserves the same due diligence, notice, testing, and follow-up as any other material change to real participant accounts. This matrix shows a tiered approach to menu design. Target date funds offer high decision support and relatively low participant customization. The participant delegates asset allocation, rebalancing, and the glide path to the fund. Managed accounts can provide more personalization by incorporating participant data, but they add service cost, model assumptions, and the need to verify that the personalization is real. Balanced funds provide a static or actively managed asset mix. A core index menu gives participants broad building blocks at low cost, but it requires them to choose and rebalance an allocation. An expanded active menu adds more manager and style choices, along with more overlap in monitoring. A brokerage window offers the greatest customization and the least built-in guidance. This is not a ranking from good to bad. Different participants need different levels of support. The design question is whether the tiers are understandable, whether each option has a distinct role, and whether the plan has defined its oversight responsibility. Expanded choice does not repeal fiduciary and communication risk. It merely gives those risks more tickers. The strongest architecture lets a disengaged participant obtain a reasonable portfolio while preserving additional choice for an engaged participant who understands what that choice requires. Fiduciary quality is demonstrated through a repeatable process, not perfect hindsight. First, define the objective. What role should the option play? Which participant need does it serve? What benchmark applies? And what criteria will drive the decision? Second, search a reasonable universe. Compare vehicle type, fees, manager, strategy, risk, operations, and participant fit. Third, select and document why the chosen option and share or unit class are prudent relative to available alternatives. Fourth, implement. Negotiate contracts, map assets, test payroll and trading, coordinate blackout periods, and communicate the change. Fifth, monitor performance, process, people, risk fees, service levels, cyber controls, and watch list triggers. Sixth, act. Retain, negotiate, replace, map, or redesign when the evidence supports action. Fees matter throughout, but cheapest is not the complete standard. The committee should determine what service and exposure the plan receives for the price and whether lower cost alternatives provide comparable value. Hindsight asks whether the fund won. Process asks whether the committee made a reasonable decision using relevant facts and then monitored it. Markets can make a prudent decision look bad for a period. A missing file, an ignored conflict, or an undocumented choice is harder to blame on the market. Now apply the chapter to the plan redesign case. The company has 1,500 employees, participation of 68%, a 3% default, a 50% match on the first 6% of pay, 28 investment options, and high turnover among younger workers. 1/3 of participants hold either cash or a single equity fund. The record keeper proposes automatic enrollment at 6%, annual escalation to 10%, a simpler core menu, target date, re-enrollment, and a higher per participant fee. Begin with design. A higher default and escalation are likely to improve contributions, but a 6% default could also raise opt-outs or reduce take-home pay for some employees. Next, evaluate the qualified default. The committee needs workforce age, income, turnover, outside benefit, and withdrawal data, plus the target date glide path, fees, and risk. Then evaluate the fee. A higher price may be reasonable if it buys better payroll integration, cybersecurity, communication, service, and measurable participant outcomes. Vendor enthusiasm is not a metric. Finally, define evidence. Participation, average deferral, full match capture, opt-outs, escalation persistence, cash concentration, target date usage, loans, cash outs, complaints, errors, and service levels. Pause the video and prepare a recommendation with one calculation, one risk, one missing fact, and one metric that would prove the redesign worked. Pause the presentation and answer all 4 questions before continuing. Question 1, what is a qualified default investment alternative, or QDIA? The correct answer is an investment alternative used for participants who do not direct their investments when the regulatory conditions are satisfied. It is not a guaranteed return, a tax deduction, or a loan exemption. Question 2, what is the 2026 elective deferral limit for most 401k participants? The correct answer is $24,500. $7,500 is the regular IRA contribution limit, while $11,250 is the special catch-up amount for eligible participants ages 60 through 63. Question 3, what does a target date glide path describe? It describes how the asset allocation and risk change over time, usually as the target date approaches and sometimes after retirement. It does not describe payroll timing, the employer match, or vesting. Question 4, what is the strongest fiduciary defense? The correct answer is a documented prudent process using relevant evidence. Later outperformance is welcome, but it does not retroactively repair a careless process. A famous provider and the absence of complaints are not substitutes for due diligence. Review any item you missed and explain why the correct answer follows from the operating logic of the plan. Carry 6 claims forward. First, design drives behavior, defaults, escalation, matching, eligibility, and menu structure influence participation and saving. Second, the plan is an operating system. Payroll, record keeping, trust, trading, data, and communication must align every pay period. Third, target date is not generic. Glide paths, fees, underlying strategies, and retirement assumptions differ across series. Fourth, contributions matter greatly. Saving rate, employer support, tenure, and leakage can dominate small investment return differences. Fifth, fees require context. Benchmark the price. Identify what the plan receives and test whether lower cost alternatives offer comparable value. Sixth, process is the fiduciary product. Define, search, select, implement, monitor, document, and act. Good plan design makes saving easier and financial heroics less necessary. That is a more useful standard than asking every participant to become a portfolio manager between payroll emails. Chapter 13 expands the analysis beyond the employer plan to IRA accounts, rollovers, Roth conversions, annuities, required distributions, and the larger challenge of turning accumulated assets into retirement income. This final page is the refresh register for Chapter 12. Posen and Hamisher provide the operating architecture. The investment company Institute sources update the size and composition of the retirement market. The IRS source supports the 2026 contribution and catch-up limits. Department of Labor materials explain qualified default investment alternatives target date fund fiduciary considerations, and plan fee analysis. ERISA provides the legal foundation for fiduciary responsibility and participant protections. Do not read the long web addresses aloud. Instead, notice what each source can prove. Official statistics can describe market scale. Rules and agency guidance can establish legal or process expectations. Industry data can show trends. None of those sources alone proves that one plan design, target date series, record keeper, or fee is prudent for a particular workforce. That conclusion requires participant facts, reasonable alternatives, documented analysis, operational testing, communication, and ongoing monitoring. The durable questions are straightforward. How does money enter? How is it invested? Where can it leak? Who controls the process? What is paid? What outcome is expected? And how will the committee know whether the system is working? Chapter 13 now carries those questions into IRA accounts, rollovers, annuities, and retirement income.